Hello and welcome back. My name is Mark Williams, and joining me is Francois Savary, CIO of Genville Wealth Management and Consulting SA. Francois, hello.
Hello, Mark.
Lots of things to talk about this morning. Obviously, the stock market rally, European markets, bonds, US dollar, gold, and the week ahead. Coming to the extraordinary stock market rally we've just had, we started out on Liberation Day. We're more or less where we started. Earnings have been stronger than were expected, but guidance is lower, and in some cases companies are refusing to give guidance. What's your take on the markets at these levels?
I think that the market reacted mainly because of the retreat from the Trump administration and the fact that they decide that after Liberation Day, they had to make a step backward and reduce the tariff that were imposed on April the 2nd. That was a main driver of the market recovery. Nevertheless, there is one thing that we need to keep in mind. There is a lot of uncertainties concerning the future economic development for the US economy. The policy that was introduced on April the 2nd brought some loss of confidence both in consumer and in manufacturing. So it's something that we need to keep in mind. When confidence is going down, usually there is a follow-up on the hard data that come a few months after. So I think that the market is a bit ahead of itself and that you should not run into the market at such level.
Are you saying that the market has overreached itself in this pullback?
I think that the market is now facing some significant hurdle around the 5,750 on the S&P 500. I think that the rally that we had was very good, and I think that the key element that you need to keep in mind when you consider April is that early April you could do a lot of mistake if you were acting too quickly. So the fact was to stick with your gun was essential in April in order to avoid significant loss on your portfolio. I think that right now there is no reason for somebody to rush in. I think that after a strong rally, the market needs to face a stabilization period. This stabilization will be in wide margin. And I think that it's too early to call the end of the risk of a bear market in the US.
We know that guidance is lower for the next quarters. What is the market looking for?
First of all, I think that he is going to look at what is happening with the Fed. You know, you had also in April a lot of pressure by the US administration on the Fed. Again, they retreated, realizing that it was putting a lot of pressure on the bond market, which was something silly to my point of view. So that's the reason why they decide to retreat, and that was a good thing. We will have the Fed this week. The FOMC is going to come out. I think that the key elements that people will have in mind is first, the hard data on the economy. We had last week the GDP number for the US economy for the first quarter. They were poor numbers. There are some statistical problems with those numbers, but nevertheless, it was a sign that things are going in the wrong direction. The second element that they will look at is the Fed. Will the Fed consider that now the slowing down in economic activity that they foresee justify to get less cautious on the inflation front, and will they lower interest rates by the mid of this year? That's the second element. And the third element, people will look at what is happening on the political front. We are coming into the period where now the administration in the US is proposing a budget. Will this budget satisfy the market is something that we will have to look very closely.
If you're cautious on American stocks, what about Europe then?
I think that at the end of the day, we saw in April that after a strong rally in European stocks, there were all the reason when the leading market is coming under pressure, that there would be a significant impact on European equities. Nevertheless, I still reckon, and this is a point that we made quite a few months ago, that if you have to choose between US and European equity, you should try to diversify your exposure into European equity the way we said we did at the end of last year. Not necessarily a defensive move. It's a move that says that you had some development lately in Europe that are positive, mainly what is happening in Germany. Don't forget that the GDP number for the first quarter in Europe were better than expected. You have some sign that the economic situation is stabilizing in Europe, and this is something that is very important. This is something that we expected and that is materializing. So it's not necessarily a defensive move. It's the fact that you have positive development in Europe, in Germany in particular. It's the fact that there are some doubts about the US economy and that you need to take that into account when you decide how to invest your money in equities between Europe and the US.
Bonds and the dollar are remaining stubbornly low. In terms of bonds, I'm talking about the price level rather than the yield, obviously. What's your take on that?
I don't like the fact that you have such a erratic move on the bond market. It tells you a lot about the fact that there is some feeling in the market that you need to be very careful with political decision in the United States in particular. I think that we are going to continue to see on the government debt front, you are going to continue to see erratic move on the yields, and I think that for me, when you look at your bond strategy, it remains my view that you need to be very cautious with US government debt and that the medium-term prospect for these assets are not particularly good.
Coming to gold now, where do you think it can retrace to? And is that
I
a
think
buying opportunity?
I think that the level of 3,200, 3,100 will be a significant support for gold prices. We tested the 3,500 during the period where there were a lot of duration on markets due to the fact that there was some attack on the Fed chairman by the US administration. So we retreat. I think that it was excessive, the 3,500 level. Nevertheless, I think that the support of 3,100, 3,200 is a good support to purchase because I think that the prospect for gold prices is still higher in the next 6 to 12 months.
Today we have leading indicators, and on Wednesday the Fed and the FOMC. First of all, leading indicators.
Okay, leading indicator is no more such a reliable indicator. It's not working so well in the course of the last few years. You had a lot of time during the 2020, 2024 period where people were forecasting a significant fall in economic activity in the US, and it did not materialize. So I don't think that the leading indicator should be seen as a key statistic to my point of view. It's much better to look at what is happening with the ISM. The ISM number, non-manufacturing, is something that is very important. We all know that the US economy suffered from a kind of manufacturing slowdown in the course of the last 18 months, but services were resisting. It's very important to see if it's still the case, if the late moves that we had are not confirmed because the ISM index went down. So this is something that is going to be very important, and take a look at prices because at the end of the day, the issue of inflation and the ability of inflation to be under control is still with us.
Coming to Wednesday with the Fed rates decision, and then FOMC statement and press conference. What are your thoughts?
I think that it's much too early for the Fed to cut rates and that they are going to stay the way they are. I still defend that there won't be any rate cut before June or even July. It's much too early for the Fed to have the visibility. They will maintain the message lately, which is okay, the trade issue is putting some pressure on economic activity or risk on economic activity, and they want to keep their option open as much as possible. But they will again relay the message that if economic activity is falling too much too quickly, they will act on the interest rates.
Thank you very much, Francois. That's all we've got time for. Thank you very much. Bye bye.
You're welcome. Bye bye.